Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet, unqualified, to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. I noticed you always seem to recommend Penn Mutual or a couple of the other mutuals, but not stock companies. Why is that? So a couple of reasons. First, maybe I should start with Penn Mutual. So regarding Penn Mutual's core business is they basically just run a life insurance business, life insurance and annuities. But its main product lines are life insurance, and it doesn't sell disability, it doesn't sell long-term care, or any of the other long-dated high-risk products. It's just life insurance, and again, like I said, some annuities, which makes it a very focused company, which in this industry is actually a good thing. So, at least in my opinion. So some agents argue that a focused company makes it riskier because they don't have any diversification. You know, if something happens to their product line, and, you know, maybe theoretically, I guess, the company could experience some financial troubles, and, maybe they just don't, I don't know. Maybe they get too concentrated in a product line. The product line doesn't pan out. It's not profitable, and then they're in big trouble because they don't have any other products they can pivot to. I don't see that so much as a liability as if they are really good at the products and really good at selling the products and really good at managing those products, which they are. Then there's the theoretical risk is going to be really low. Diversification for diversification's sake it tends to be pretty risky. We've seen that in companies that did that and then got into businesses that they didn't have very good competence in, and then it was that diversification into those other lines of business that caused problems for certain carriers. So anyway, it makes companies like Penn Mutual very focused, Penn Mutual's ratings are all very strong, either rated very strong or superior. In particular, I'm talking about AM Best, which has maintained Penn Mutual's A rating for, I think, about 100 years, consecutive years. So you don't get to keep those ratings by taking excessive risks. So they're clearly doing something right. The other thing is a lot of people want to do this infinite banking thing, and Penn's policies have a lot more flexibility for that financial concept than many other life insurance companies. So there's some exceptions, and I'll get to those later. But Penn Mutual is a very flexible whole life product for that. So most companies are pretty restrictive in how the PUA rider works, the paid up additions rider, for example. So a lot of my clients take for granted that they can just arbitrarily send money to their insurance company and buy up their cash value and death benefit on their policy whenever they want. The reality is that most life insurers that sell participating whole life don't allow unscheduled premiums like this. They don't like it, and because it's uncertain cash flow. And if a carrier does not have a way to manage that uncertain or unexpected cash flow, then it creates a certain, say it's not really a liability, but it creates a certain kind of problem for them. So the reason that Penn is able to do this is they underwrite it when you take out your policy. They've already accounted for the risks of the policyholders, varying their cash flows. So they also are pretty good about allocating capital. They're just, they're a mid-sized carrier, and they have the means to accept uneven cash flows, and they know how to invest it. So I once talked to Guardian about doing something similar to the types of things that Penn Mutual does. There's certain quirks about Penn's policies. The person I talked to looked at me like I had alligators coming out my ears for some reason. Guardian has its own flexibility that's built in that's really, really nice. It's just not exactly the same as what you can do with Penn. In some ways it's better, and in other ways it's worse. So it's not that the other mutuals aren't good, but their products, some of them aren't as flexible. I would say Mass Mutual is if I'm going to call one out. I own a Mass Mutual policy. It's just they're not very flexible on their premium structure. So in their PUA rider. So, the exceptions to that flexibility piece would be Guardian, which is very flexible in their PUA rider, and New York Life, also very flexible. So Guardian does have some drawbacks in regards to how they underwrite and a few other small quirks to their contracts, but, they're another great company if you want to use what I call, I don't know, some people call it infinite banking, family banking. Shadow banking is kind of more. That one sounds a little more. I don't know. It sounds a little bit more. Devious is not really the right word. Sort of like maybe dark and like you're up to something. Anyway, don't get me wrong. If Penn Mutual for some reason decided to nix its current product line or nerf it in some way, I would absolutely recommend other companies. New York Life is the oldest mutual, and they have probably, I don't know, I would say maybe the most flexible in terms of how low and how high you can go on their PUA rider. Guardian is another one. I would probably exclude Mass unless they changed something about their product design. Outside of that, there's no real reason why anyone needs to do business with Penn Mutual specifically. They're a great company, but there's also several other great companies that you can buy a whole life from. And sometimes Penn Mutual isn't the greatest company to go with. They have their own quirks on policy design and what a policyholder can and cannot do with their products. So it just depends on what the policyholder wants from the policy. There's no one company that I would say is at risk of something bad happening to them. Their balance sheets are clean. Their products are typically very low risk. Among those three carriers that I mentioned, their product line is low. The product risk is low, meaning that they're not selling products that are, overly generous or something that's going to get them into financial trouble later. So, and Guardian is considered one of the more generous carriers, but even they don't get so generous that they're very, very generous in their provisions and stuff, but they don't go so far out over their skis that it puts them into, into trouble later on down the road. So the old mutuals, that I look at seriously, would be Penn Mutual, Guardian, New York Life, Mass Mutual if there weren't any other options. People like to call out Northwestern. They're a great company. I don't do business with them there's logistical reasons why I don't and can't really do business with them. But all of those carriers are very well capitalized. They have a low risk product portfolio. Possibly the riskiest might be Mass Mutual due to its large group annuity business. They do have some very generous long-term care riders, and just the breadth of his business. But even still, like Mass is a low risk company, compared to some of the other carriers out there. Mass maintains excellent financial ratings just like everybody else. And they've never reneged on any of their promises to policyholders. So it's weird to me. Every once in a while, I'll get people asking about whether, I don't trust. They'll say something like, an objection that people would bring up is that, I don't trust insurance companies. They're always trying to find a way to not pay. I am not aware of a time when any of the old mutuals or the major carriers, top tier carriers, have flat out denied a claim. Sometimes they will challenge a claim if it's within the contestability period and there's a legitimate reason to contest it. But otherwise, they're not trying. It's not like in homeowners insurance and auto insurance where an adjuster comes by and tries to whittle down the amount that can be paid out. With life insurance, you are either dead or alive, and that's it. And if you're dead, the benefits are going to pay out. So there's no negotiation on that front. But I would say you compare to stock companies. I don't know of a stock company that's in any financial trouble. So on that front, I'd say I don't have a problem with them. But the business model for publicly traded companies is very different from mutually owned companies. For starters, stock companies have a reputation for selling trend products, meaning they'll introduce a new product line every 5 to 10 years and then update their products based on current market trends. So in the 1980s, they sold boatloads of interest-sensitive universal life. When interest rates fell and the products suffered, they introduced variable universal life that was in the 90s. And that product did well up until the dot-com crash. And then insurers they diversified into guaranteed UL products. And then they introduced indexed UL products. So, halfway through the last bull market, they pivoted again to curb sales of guaranteed UL because it was just getting too expensive for them to sell. The capital requirements, the reserves they had to post, it was a lot, and it was just getting too much. So they started pushing VUL, variable life again, and then index life. So now index life, universal life products those products are now facing headwinds just because of the options market and there's certain complexities in there that are making it, increasingly more difficult to, design products and have them perform the way that, the marketing literature says they should. So now they're pivoting again to hybrid VUL, IUL products. And then guaranteed IUL products you're starting to see, the guaranteed, instead of guaranteed UL, you're getting guaranteed index UL. So it works kind of like the old GUL products, but with an index crediting features. It's not made for cash accumulation. They're made for guaranteed death benefit. So the industry just keeps pivoting to different things and different iterations on the same universal life chassis because it's a trend product. They don't have the same products. Like mutual carriers have the same product year in and year out for like 100 years. Whereas you don't see that in the universal life space. So it's basically an endless merry-go-round with these products. And when they get too expensive, to service and whatnot, it gets to a point where, they'll just start selling blocks of business off to like foreign hedge funds, literally in the Cayman Islands, or some other company that has no history with the insurance business. And then its main focus is, when the new owner of that block of business, has to figure it out. And their main goal is to squeeze as much money out of the business as possible, i.e. the policyholders. So, this is a completely opposite way of how mutual companies are run. And it's why I continue to focus on mutual carriers, and I mostly avoid stock companies, except in maybe in limited circumstances. But mutual companies mainly sell whole life insurance, term insurance, and, they do sell universal life. But, they hold on to those products for decades. They have like a book of business that spans, 30 years, 40 years, 50 years. So they rarely refresh their products unless they need to reprice it. They might add tweaks and features and stuff like that, but it's fundamentally the same products over and over again on the books for, 50 plus years. The downside to the mutuals is that they aren't nearly as sexy, I would say, as stock companies. They don't offer shiny new products every few years. And while I don't like the business model of some of the companies, I have to hand it to them. Like some of the technology they employ is really very slick, especially with mobile apps and stuff like that. So, some of the product features are also very nice. So like years ago, I recall there was a company that had an unemployment rider on one of its life insurance products. So if you lost your job, the company would supplement your unemployment insurance benefits. You don't see that stuff from a mutual carrier. The one that I would say would have the highest chance of something like that would be like Guardian might in the future maybe offer something like that. I could see them doing something like that. But for the most part, the mutuals don't do that. So mutuals tend to be slow growers, since their main source of revenue is premiums. That's it. They don't get outside financing or capital access to the capital markets. So they can't just raise money in the same way a stock company can. So And also mutuals have a reputation for being very conservative and old school, frankly. They tend to resist change, unless it's absolutely necessary. So, as an example, the mutuals have resisted online payment systems. Like, they just won't do it, and until just recently, they said they have started doing it, but for some types of payments, they still require checks, and some paperwork still has to be processed via fax machine, if you can believe it. So it's a very old school sort of attitude to doing business. And that attitude is changing, but it's only in the last 5 or 10 years or so that things have started changing. So, and some people don't like that. Some people want like the latest and greatest, technology in their financial products. But, it's so depending on how you look at it, could be, I guess, an advantage or disadvantage. But either way, that's the story on the mutuals, and I choose to stick with them. I think it's a good long-term business model. It's very pro policyholder. Management tends to be aligned with the policyholders because they all, the management in mutuals, which is kind of, maybe, I don't know if it's an open secret, but a lot of them own insurance from the companies they work at. So the executives at Penn Mutual own Penn Mutual policies. The executives at Mass own Mass mutual policies. The executives that work at Guardian own Guardian whole life products. So it keeps them focused on the dividend and kind of like the incentive is to make sure the business lasts, because the management a lot of times is right there, standing right there alongside the rest of the policyholders. Anyway, I hope that answers your question, and I will see you in the next one. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, monegeniix.com, and sign up for my daily email list.